Hey there. I'm in New York this week, trying to get a handle on the US economy. It feels like a split-screen movie right now. On top, you've got solid economic growth and a booming stock market. Consumers shelling out for the holidays. Just outside this studio, Times Square is packed with tourists. But on the bottom, you've got sticky inflation, worries about the cost of living, and crucially, questions about the health of the labour market. Economists talk about a no-fire, no-hire state, or the jobless expansion. But what does that mean for the millions of people who are looking for a job and the wider economy? Let's try and find out. I'm Carmel Crimmins, and this is Reuters Econ World. Every week we go deep on the economic principles and ideas driving the biggest news around the world. On this week's show, the labour market. Hey, Dan.
Hey, Carl.
It's great to be in New York here with you.
It's fabulous to be with you.
One of our favorite guests on the show. I always like to get you on to talk about the complex stuff. And Dan, I have to say, I find the US labor market difficult to get my head around. Is it fair to say it's always a tricky thing to try and work out how it's doing?
It is in this moment,
right?
Probably more so than it has been for a while. It's complicated by things like the government shutdown for 6 weeks that disrupted the flow of economic data in its entirety for a month and a half.
Yeah.
But even before that, there have been problems really measuring the labor market through the statistical agency that governs this, the Bureau of Labor Statistics, has had issues with the timeliness of its surveys, response rates, keeping up with technology.
Yeah.
Leadership changes,
right?
All of which have added up to make it kind of a murky subject right now.
Talk us through the different ways of measuring how the labor market is doing, because I think people will be familiar with things like the non-farm payrolls, even though they might not be quite sure what that means. What are the indicators? So
non-farm payrolls is the main one.
Right.
And that's actually an amalgamation of several surveys, two main surveys, but there's also more contemporaneous data. We get from all the 50 states and key territories, we get a report each week about how many people are signing up for jobless benefits because they've lost a job.
Yeah.
And how many continue to be on those benefits for more than a week. We also get openings and job openings and labor turnover surveys, seen as less reliable, but still something that we keep an eye on. And then there's some private sector reports. Most notably, we get ADP, the big payroll processor,
right,
has its measure of private payroll growth in the across the economy. And then there's a number of other ones that are emerging and certainly grew in importance over the 6 weeks of data hiatus that we suffered.
Right. You mentioned there about leadership changes at the statistical agency. And you're right, we did a podcast on that before, Dan, about President Trump firing the head of the labor statistics unit over an unfavorable looking employment report. I mean, the firing was controversial, but there are
Absolutely.
Concerns, aren't there, about the sort of the accuracy of the data, right?
There have been for some time. And the firing really cast a really stark light on that in that moment. But the Bureau of Labor Statistics, not just in the payrolls data, but also in its inflation data, has had difficulty with response rates, with getting the full complement of the data in hand each month. It's a tall order to begin with, but when you have businesses that are not as responsive to surveys as they had been previously,
right,
you get a lot of volatility in the job creation numbers. When households are less willing to participate in the survey of households where we get the unemployment rate from, that makes it much more difficult. And of course, we missed the entire month of October in data. And when we get the next report, we're not going to get an unemployment rate.
And that's all down to the shutdown, right?
That's all down to the shutdown.
So given all those numbers that you talked about, the payrolls, the jobless claims, the unemployment report, what is the best measure?
Economists really still settle consistently on the unemployment rate.
Okay.
Right? And it's also what households, what everyday consumers and American citizens sense is the best measure of the job market.
Yeah.
It's really hard for them to contextualize 400,000 jobs, created versus, 75,000 or 15,000 or 23,000 lost. But they understand when you tell them that the jobless rate is 4.4% or 8%. They really know that difference.
Right. You're able to tell from that what percentage of the labor force is unemployed. Like
exactly. And looking for work.
And looking for work.
Right? Which is also that's part of the pain, right? Because it's not just people who have lost a job and left the workforce. It's people who are trying to find a job, and they know it's harder to find a job when the unemployment rate is 8% versus what it is now at about 4.4%.
So given that, what is the unemployment rate right now telling us about the economy?
Well, it is still historically low, but there's some confusion around it right now because there are other dynamics that are contributing to it. It's not your grandfather's 4.4%.
Right.
Okay.
Because 4.4 sounds good, particularly for me coming from Europe. That sounds to me like a concept called full employment, right? Because there's always people in the labor market at any one time who are unemployed, right?
Right. But it's a 4.4% that is coming with a difficult job finding market right now.
And that's why people are worried?
That's really why people and consumers are worried. You look at surveys of consumers, their thoughts about the job market right now, they're more fearful than they were a year ago about losing a job. And they're pronouncedly more worried about finding a new job should they lose their current job.
All right, quiz time. The US unemployment rate reached double digits only once during the second half of the 20th century. That was at the end of 1982, during a nationwide economic recession. Some economists say that recession was triggered by the Federal Reserve, which raised interest rates to combat a brutal bout of inflation. So who was the famous Fed chair who led the campaign to battle inflation? Was it A, Arthur Burns, B, Arthur Laffer, or C, Paul Volcker? We'll have the answer for you at the end of the show. Up next, we take a look at the supply side of the US labor market. Dan, let's look at some of the forces shaping the supply side of the labor market. One of the big sort of forces right now at work is immigration, isn't it? Or the lack of.
Due to policies from President Donald Trump.
Right.
He's cracking down on illegal immigration, on legal immigration. Over the last couple of years of the Biden administration, almost all of the workforce growth and a lot of the job growth was among foreign-born new entrants to the workforce and job finders.
Got it.
Not native-born Americans. That's completely switched in the 10 months since Donald Trump has returned to the White House. All of the jobs that we've seen created over the short term yet of his presidency have been, according to BLS data, have been from native-born Americans. And in fact, about 1 million fewer foreign-born people are employed and in the workforce now than were in January.
Right, so it's shrinking the supply of labor.
It is. We've seen a modest overall increase in the workforce, but not at the growth rate that we'd seen previous to Trump returning.
So that means basically the unemployment rate would be worse were it not for this factor.
Yes, I mean, because it's a little bit of basic arithmetic.
Yeah.
Right?
Yeah.
And the unemployment rate is the number of people unemployed divided by the size of the workforce.
Right.
Right. And so if we're at a point now where that limited supply is really flattering the unemployment rate.
Right.
Because you don't need as many jobs created each month to keep the unemployment rate steady. And we've seen a significant drop-off in job creation this year. And the unemployment rate has edged up over the course of the year by a couple tenths of a %. And it's not looking like it's going to shoot higher anytime soon.
There's also another factor at play, isn't there? And that's demographics, right?
Absolutely. Right. I mean, some of those demographics I spoke to about the immigration status, but there is a divergence, a new divergence in, for instance, the rate of unemployment among whites and among Black Americans. That gap had narrowed historically 2 years ago to less than 2 percentage points. It's widened back out to about 3, almost 4 percentage points, high threes. And it looks like it's going to continuing to widen, not shoot higher, but continue. And a lot of economists see that as a bit of a canary in a coal mine.
Why is that?
Well, it's last in, first out right? An expanding economy usually in its early stages picks up the people are easiest to employ, those with skills, those with high levels of education. And unfortunately, that's in the United States, that's an attribute not always attached to some demographic groups, right? So they're the last to see gains in an expansion, and they're the first to go out when things contract.
There's other demographics going on as well, isn't there, in terms of the baby boomers leaving the labor force?
That's a big part of it too, right? So we're in the midst of a secular wave of retirements of people. Millions of people are reaching retirement age each year now in the United States, and will for, frankly, the foreseeable future as the baby boomers age out of the workforce. And now soon we're going to start to see the generation after them, the Gen X people, starting to age out of the workforce in sizable numbers. And there's not enough new people coming in to backfill them.
Are there particular industries or sectors that are affected by this kind of crunch on supply, both from the kind of the immigration side of things, but also from the older workers leaving the labor force?
Well, certainly on immigration, there are a number of sectors that are particularly affected by a shortage of immigrant labor. Construction, overrepresentation of, for instance, Hispanic workers. Home healthcare. Healthcare is another big part of that. So you do see some demographic effects, and we've seen some of that.
I mean, the flip side of it as well is, are we also seeing, from a demographic perspective, people are living longer? So are you also seeing maybe people hanging on longer in the labor force? Is that a thing as well?
It had been. There had been a period where we had seen older workers over contributing to the workforce and the labor force.
Do you mean they were just hanging around too long and just basically taking up a job that a younger person
and then some were rejoining the labor force after being out of it. Sometimes for reasons of financial distress. We saw some of that dynamic following the global financial crisis.
Right.
But in the current environment, things like you referenced off the top of the show, a booming stock market is making it easier for people who have had 401ks that they've consistently contributed to and had them overinvested maybe in the stock market to now have comfortable nest eggs that they can retire with.
If markets and finance are your thing, then check out our brand new sister pod, Reuters Morning Bid. It's your go-to market briefing 7 days a week. Just ask your smart speaker for Reuters Morning Bid and get that market edge straight from our experts in the Reuters newsroom. You can also listen to it on your favorite podcast player or watch along on Spotify. Stay tuned for the next part of the show, where we look at the demand side of things. On the demand side as well, Dan, there's a lot of interesting factors at play, aren't there? Like, I suppose maybe top of mind for lots of people is AI and the potential impact that's having. We've seen some big companies coming out, laying off workers. Some of them have been referencing AI. Like, is it kind of the start of the AI layoffs?
That's the huge debate in policy circles and households around dinner tables among families with young college graduates who are finding it more difficult to find a job than it was the case 4 or 5 years ago.
Right.
So right now it's in the realm of very common anecdotal evidence that this is the case. It's not something yet that people are comfortable saying is really evident in hard data that we see from BLS or other big statistical agencies. But it is certainly the conversation of the moment, and it's what everybody is talking about.
Certainly is in my house. I've got school-age kids. What are they going to do? They can't. I need a return on my investment, Dan. I mean, we are seeing more young people going into trades, like as a reaction to kind of the AI potential threat.
There is some indication of that, and it certainly could grow. The rate at which people are landing new jobs right out of college is, one of the lowest we've seen in a number of years, and it's making it more appealing to think about, going into carpentry, plumbing, being an electrician, so there is some indication that that's underway.
Also, the theater might be a good option, right?
We're right here.
You're not going to go.
Give it a shot. Broadway's 10 feet away.
You're not going to go to the theater to watch the robots, right? That's the other thing. So if anyone's got any drama queens at home, that there could be a future for them. I mean, are there other demand aspects as well out there in terms of AI is one thing, but also the business environment. It's uncertain, right?
It is uncertain, and there had been a heck of a lot of hiring coming, in the emergence from the pandemic.
Right.
And there was a reluctance to fire. So we talk about
labor hoarding.
There was this labor hoarding, and to some degree that still is happening, but people are allowing it to bleed off through attrition, retirements. We're not seeing a lot of firing activity, really. We see that, pretty clearly in the weekly unemployment benefits claims data, but there is certainly a broad-based demand reluctance, particularly it seems among smaller businesses, and whose uncertainty is probably much more elevated against the very meteoric policy environment that they're in under President Trump.
Right. And also that AI could be a factor there as well, I suppose, if they're thinking that potentially if AI could be a help for them in their business, then best not to hire now.
They might fire down the line. If you can muddle through, wait it out. You hear that quite a bit.
The other thing, of course, is that it's kind of like the no fire, but also the no hire state, right? And so there is evidence out there, isn't there, that it's harder for people when you've lost your job to find a new one.
Certainly. And one of the great measures of that is in the weekly unemployment claims data. Right. There's two parts of that. There's the brand new people seeking benefits for the first time. And when you see a spike in that, you really know something has gone wrong.
Yeah.
And when it does go up dramatically, it tends to go up really fast, really far. We haven't seen that yet. But at the same time, it's the number of people who continue to need benefits for more than a week or two. And that is hovering around the highest in 4 years or so. And it's perfectly indicative of the no fire, no hire environment. If you are one of the few who is unfortunate enough to lose a job, it isn't easy to find a new one in this market.
Is there a stat out there, like the average amount of time it takes someone to find a job? Is that something that's out there?
Yes, absolutely. The BLS tracks how long people are unemployed on unemployment benefits, and that's been growing. The average right now is up to 24 weeks, a little bit more than that.
Wow.
From less than 20 weeks just a couple of years ago. So that's really shows a light on just how hard it's been getting to find a job after you've lost one.
If you like this podcast, why not subscribe to the newsletter that accompanies it? It's also called Reuters Econ World, and it spotlights our best coverage of finance and economics. It's published straight to your inbox every Thursday. We've put a link to the sign-up in the description of today's show. In the final part of this episode, we look at what might be coming next. So Dan, one of the reasons why I suppose the Fed is so much in focus right now and there's question marks over where interest rates go is because on the one hand, you've got sticky inflation, but you've also got this question mark over the labor market, right?
It is the debate at the Fed right now.
Right.
And it's not resolved. The data that we've gotten since the shutdown ended has not brought any clarity or been strong enough in one direction or another to move anybody off the markers that they've established for themselves as either hawkish and being worried and about more interest rate cuts because of inflation, or dovish because they're worried about the job market and needing to help it with more rate cuts.
And that's because the Fed has what's called a dual mandate, right?
Exactly.
It has to focus on inflation on the one side, so rising prices, and on the other side, the health of the labor market.
Right, exactly. And that dual mandate has created dueling camps inside the Fed right now.
Right.
And we could see a very large number of dissents when they come out with their decision in just a few hours.
Kind of in the evolution of where we're at in the labor market and the business cycle, like things do move in cycles. And we saw after COVID, there was a real power shift. Suddenly it was the employees seemed to have the kind of the power on their side. There was, the kind of the great resignation and things like that. Has that now shifted? And is it the employers who have the power?
Employers are in a much stronger position right now. You just look at that imbalance between the number of people looking for a job, how long it's taking to find a job.
Yeah.
And that really does show that balance of power has clearly shifted toward employers right now.
This is a problem, isn't it, for the Trump administration, right? I mean, on the one hand, they're obviously dealing with the kind of the affordability issue, as it were. But if things start to crack on the labor market, that is a big, big problem.
It would be. It doesn't necessarily have to crack to be a problem. If the next year, say, there's a decent prospect to see pretty good GDP growth because of a number of factors coming out of the tax bill that take effect in 2026. People are going to see larger refunds. They're going to see less taken out of their paycheck in taxes. Businesses are going to be able to expense more quickly the investments they make, which will, is likely to help boost CapEx and other things. That all will help lift GDP, but there doesn't look like there's a real prospect for accelerated job growth. So you could get this moniker hung on them like the first Bush did of a jobless recovery.
Right.
And that's not one that they're going to want to sit with.
Right. So it means on the one hand, the GDP figures look good, but the jobless figures don't.
Right. Well, the joblessness figures could be okay.
Yeah.
But the job creation figures are likely to be low. Most of the economists whose research I follow are estimating average job growth over the next year to be in the neighborhood of about 30,000, which, as we talked about with the supply dynamics, is right around that break-even rate, which means we're not likely to see a big rise in the unemployment rate in that environment, but we're not going to be having people popping corks about big job growth.
Right. What does that mean for the world's biggest economy if you have an expansion without major jobs growth? Like over the like the medium term, even, does it sort of eat itself in the sense that it can't last? There's
a number of things that can help perpetuate it.
Okay.
AI productivity is certainly one of those that people are pointing to as one of the factors that could sustain this for some time and make it feel not so bad.
Right.
Unless you are somebody desperate to find a job and finding a skills mismatch and having to retrain.
Not so bad for certain people, I suppose, certain categories, right? But if you actually can't find a job, it's dire.
And still, while there have been, there was news quite a bit in the last few months about a wave of layoff announcements. They dropped again last month.
Yeah.
So it isn't something that's persistent. So most people are in a position where they're going to keep their job and they're going to be in pretty good shape. But those unfortunate few who lose or are coming into the job market for the first time without the right skills in this moment, it's not going to be a happy experience.
It could also make the labor force itself kind of sticky, couldn't it? In the sense that if you have a job and you see that it's not easy to get a new one, you're probably less likely to jump ship. Like you might sort of hoard your own labor, as it were.
You might. And that's something that a number of surveys, the New York Fed surveys on a number of labor market dynamics and willingness to leave a job on the expectation that you could find another one quickly, that has fallen off.
I mean, in the historical sweep of things, is this new? Like, have we had this before where you have like a jobless expansion? Or is this a kind of a brand new trend?
Well, in the early 90s, we did, right? And it cost George H.W. Bush the presidency back in, to Bill Clinton.
Right.
So there is precedent for this. It's not clear that in this environment that it could have quite the same political cost.
Really? You don't think so?
All I'm saying is it's not clear.
Right.
Back in that dynamic, the unemployment rate was already substantially higher coming out of a recession.
Right.
And it was a jobless recovery.
Right.
We're not in a recession right now. There doesn't look like there's one around the corner, but we've got this quirky job market where the unemployment rate doesn't look like it's going up, but it doesn't look like employers are opening the doors and say, come work for me.
Dan, we've kind of been down on AI, right, in terms of its impact on the labor market. I mean, is there anything on the positive side that AI could be bringing to the table?
Well, it certainly triggered a huge investment boom, and that's expected to continue. And it may end up in 2026 and 2027 not being the only investment game in town.
Right.
And that's an expectation a number of economists have, certainly the administration has, as a result of the expensing part of the tax bill, where you can write off a new investment over a much shorter time. That's a big tax advantage for companies.
Right.
And if that does spur CapEx investment, as a lot of people are predicting, certainly the administration is, over the next 12 to 24 months, CapEx expansions are usually followed by employment growth expansions.
Dan, on that slightly hopeful note, thank you so much for your time.
Thank you. Always a pleasure.
A big thank you to Dan for his time and insights. There's so much more to Reuters Econ World than just the pod. Unlock all of Reuters finance and economics reporting from across the globe by checking out our website or app. Now for that quiz. I asked you to pick out the name of the Federal Reserve chairman who raised interest rates to combat inflation and triggered a spike in unemployment during the early 1980s. Was it A, Arthur Burns, B, Arthur Laffer, or C, Paul Volcker? And the answer is C, Paul Volcker. The cigar-smoking economist was appointed Fed chair in 1979, and when he took office, annual inflation was running at over 11%. And despite some serious pain in the labour market, Volcker managed to get that down to below 4% by 1983. Today's Fed chair, Jay Powell, cited Volcker as a model during his own fight against inflation after COVID, calling him, quote, the greatest economic public servant of the era. This is Reuters Econ World. Every week we go deep on the economic principles and ideas driving the biggest news around the world. If you want to tell us what you thought of this week's show, please drop a line in the comment section of your favourite podcast platform. You can also reach out to me on LinkedIn. This episode was produced by Ethan Plotkin and Eliza Davis-Beard. Sound design, music composition and engineering was by Josh Summer and Sebastian Summer. Our executive producer is Leela de Kretzer. Remember, for all your daily markets and finance news, just ask your smart speaker for Reuters Morning Bid 7 days a week. It's available across all podcast platforms. And if you like to see the faces behind the voices, you can watch it on Spotify. I'll see you back here next week.